Now we're going to turn to the refined products. What have we seen? What do we expect to happen as we go through the end of Labor Day, as we get through to Labor Day and then beyond? And we always like to start out with the summary chart. So the current data is for 15.296 million barrels a day of demand. Last week was 15.5. Bringing us to that 4-week rolling average right around here at about 15.25 million. So one of the things that we were saying last week was that we were going to get an increase in gasoline, but a decrease in diesel and jet fuel, which were going to offset each other. So that's what we really had kind of essentially set up here. And we should get one more push higher when you look at the seasonality of it, looking at 2018, 2017, and 2019, 2019 and 2018, you had that fairly big increase of demand. It's just we're not going to see the same type of gasoline push. We will see gasoline demand stay fairly elevated week over week when you consider that you had Henry coming through, so people rushed to fill up. You had about a 5% increase in Pad 1 because of it, most of it being really along the coast and into the Northeast. So that's going to provide some of that bid behind it, but you do have seasonality coming through. You have kids going back to school, end of vacation season, and really what seems to be kind of playing out is those are starting to get, they saw their families July 4th, and now they're going to stay local or not do as much during Labor Day, which is going to offset some of that normal increase. We will get an increase. It's just going to be below, again, what is seasonally normal. And we expect this to start to fall, to drop off, similar to what we have seen over the last, 4 years or so, when you see that drop back below that 15 million, and we expect to come in closer to about 14.7, 14.8 when you start looking at what is normal and where we are versus, and then again, turning to jet fuel, diesel, and gasoline. Gasoline and jet fuel will continue to be below seasonal norms, and diesel we expect to be either at or, slightly above those seasonal norms, which will be the bright spot in comparison to the other two. So now when we turn to what is happening on the disti front, so you had a small build of 650,000 barrels, still 11.1 million below the 5-year average, but you can see that still is 100% caused by Pad 1, where Pad 1 is still 11.6 million below the 5-year average, which just means that everywhere else is either slightly normal, slightly above normal. So we had Pad 1 with a build of 840,000 barrels. And now that we have this diesel coming into the Atlantic Basin, as we keep talking about, it continues to flow through. The question is going to be, what is the better market? Is it going to be Pad 1 or is it going to be Europe? And you can see here where we typically get builds, we're building along the 29-year average, but that's still quite low in comparison to previous years. So there's still opportunity to see a little bit of ramp up, and guys to be, traders to be a bit advantageous, which we've already seen with imports. Imports increased 145,000 barrels a day, which is 121,000 above the 5-year average. And most of that was into Pad 1 with an increase of 134,000 barrels. As these cargoes come into the Atlantic Basin, we'll see this remain elevated into Pad 1, given the spare capacity and storage and the ability to try to take this down, especially as we get ready for heating demand as we start looking towards the winter pull. And then Pad 5 will also remain elevated as we do have more cargoes coming from South Korea, Japan, India into the Pad 5, which some of that is normal, some of it isn't as normal, just given just where that locale is and what that's going to look like as we head through the remainder of not only just summer, but as we get into September and October, where we typically start to see those builds increase, as you can see, just based on where storage is. And then we start to get some of these draws as we get into the October month, middle of October month. Then when we look at production, production increased of disti was up 138,000 barrels a day. or an increase of about 74 basis points, bringing us to about 31% yield, with, again, that focus being on the disty side. And then when we look at gasoline was down a touch to about 62%, which is down about 42 basis points. So you can see we're starting to get that lean towards the disty cut. And again, that's going to require a slightly heavier API, which is going to support some of these imports, which is why we see this capacity in floating storage. And it's just going to put, essentially put a little bit of weight on how much is going to be consumed that we're producing locally. And as our exports continue to face some of these headwinds, that'll keep some of this crude into storage, again, keeping those draws fairly muted over the next few weeks. Then when we look at supply demand for disty, this is what we were talking about. We expected to see a drop back to the 5-year average, still slightly above the 5-year average, and we just think it's going to go sideways from here, again, remaining above the 5-year, still remaining strong. Maybe it has another pullback, just depending on how Henry impacted some of these pulls and how the product was going from, the blenders to the actual pump. That's just going to be a matter of timing. But again, we should still see this demand remaining strong, as we're starting to get a peak back up in truck truck demand up to 145. You can see that load availability is stabilized. There's a little bit of a deviation in terms of refrigerated trucking rates, but then when you start looking at flatbed, specialized, starting to come down a bit. And it's just a matter of how much capacity is there. This is typically the quiet before the storm, as now you start to get a big increase in guys trying to pull down inventory for Christmas, for the holiday season. So that's typically when you start to see this ramp up as we head into September and October. As I've told my wife, I'll tell everyone who watches this. Hopefully most of you, or I know I'm related to a lot of you, so hopefully we get more subscribers and watchers. But when we look at what is coming, it's not that we won't be able to purchase goods for Christmas, Hanukkah, other. It's just there's not going to be a lot of toys available. There's not going to be a lot of stuff available. It'll be available, but a finite quantity, with an uncertainty of getting some of this backfill. So it's just a warning to start purchasing a little early. Make sure that you have what you want, and just because that storage, that inventory just won't be there, and that's something that is going to essentially support some of this near-term trucking demand. Now on the rail side, rail has continued to cool off, and it's really just driven based on where we were in 2020. Because remember, there was this huge surge in 2020 as we got through the end of summer to try to make up for some of this capacity. The motor vehicles is going to continue to be weak. The chip side, having a lot of these parts match up has been very difficult. That's going to remain a struggle. But then when we look at grains, that's going to remain. Last year was a tough comp, so it's still strong. It's still going to remain strong. Coal's still elevated. That's going to remain elevated as well as some of these metallics and metals. The one side that we think is the intermodal. Intermodal has slowed down. That's something that we expect to pick back up. Similar reasons to the trucking. This is just a much bigger overhaul, because instead of moving one, you're moving 100. When you think about the average rail car, train car that's pulling all of this capacity. So this is going to be something to watch, where we still expect grain and intermodal to be supportive of rail traffic going forward. And this is providing some of that support. So when we look at what is coming into the LA ports, you can see that, we're still well over week, year over year, especially when we look into September, where you get this big surge, and that surge is continuing to increase in general as we continue to see, again, these movements of cargoes into the system. We're trying to replenish some of this capacity as rates remain at record highs, and you still have a lot of this disruption. When we go back through the supply chain and all the way into Asia, there's still going to be some of those hindrances to capacity, which is going to make this lumpy, and you're going to see some of this come down. But we still have these backlogs at our port. So even if there's that delay of new cargoes coming into the U.S., you can see going out to September 11th, there's still a lot of wood to chop, and that'll just be replaced by what is delayed. So then when we look at temperatures, you can see we still have some heat pretty much across the U.S. This is going to keep things a bit hot. At least by me, we're going to be in the upper 90s, the low 90s, upper 80s. Essentially through the rest of this week, and then things start to cool off a little bit, something closer to normal. So you'll start to see this kind of balance out as we head into September. Again, just a little bit supportive of natural gas, of just in terms of what is cooling demand, where is cooling needs, electricity demand. So that'll be supportive. Now, when we turn to gasoline, so gasoline had a draw of 224,000 barrels out of storage. That brings us below the 7-year average by the 5-year average by 7.4 million. And it was really driven by Pad 1. So Pad 1 had a draw of 2.32 million barrels. That's 8.3 million below the 5-year. And again, that comes down to how much of that was pulled through because of Henry, trying to get some of these barrels in front of it. And that's where we'll start to see some of this adjustment, which you can see in the blending components where draws were at 2.24 million, but the draw of blending components was about 1.09 million, and that's only 1.9 million below the 5-year average. And I think that's closer to what the draw should have been versus what was pushed through the system. So that's going to be something to watch. So we should get a little bit of a makeup on the back end, but we did get a big increase in imports of 333,000 barrels a day. That's about 1.076 million versus last week, 743,000. And it was driven by Pad 1, which had an increase of 379,000, and then Pad 5, which had an increase of 63,000. So when we look at what is normal, it's important to look at Pad 5. So Pad 5 is 167,000 above the 5-year average, and Pad 1 is only 92,000 above the 5-year average. So when we look at what is going to be the bigger driver, we continue to talk about Pad 5. There's a lot of that clean product coming from Asia into Pad 5, and that's going to keep us fairly elevated. Now, we will see that drop in Pad 1, and it's a little tough because technically the ARB should be open coming from Europe into the US, but Europe capacity, or I should say storage, has dropped. So that's going to put a little bit of pressure of new flow into the US. We're now at about 260,000 barrels a day coming in, 260,000 barrels coming into the US, in terms of, it's a little bit over the week of August 13th. But still, just going to be that timing. So we will see that drop back down. But when we look at storage in general, you can see we're just moving well within the normal cloud. We typically see this get start to turn, let's just call it a little bit before September 18th, where the last drawdown is typically what we normally see of Labor Day. Obviously depending on when Labor Day falls, and then we start to see not so much a huge build, but just kind of this steady move up. And as we've been talking about, when we look at where we are versus 2021, we're just barely off of the low point of 2021. And just the comps get harder as we expect to see draws. It's just the draws, we don't expect them to increase in pace, but be fairly muted as we go through the remainder of driving season, if you will, and then pivot into shoulder season. So then when we look at U.S. retail and recreation, you can see that we've had some stabilization, which is what we've been talking about, where we didn't expect the Delta variant to be a huge hit, just given where things are, who is vaccinated and not vaccinated. We have seen a bit of an increase in masks, even without the mandate. It's just people taking some precaution, but again, not really changing normal activities, and that's something that we expect to continue over the next few weeks. And Dick's Sporting Goods actually just took their expectations higher. Again, people buying recreational stuff, trying to get outdoors and be a bit more active. On the flip side, we are seeing a slowdown in back to work. Some people did go back to the office. The companies have told them go back home, just try to, and you're starting to see a delay of office coming back to the office till about 2021. A lot of guys in tech, you're starting to see that on the industrial side, where you're starting to see this pivot, and you are seeing a demand increase for work from home, and really more along the lines of flexible schedules. And that's something to consider when we start looking at, what is happening with normal driving. So according to GasBuddy data, weekly U.S. gasoline demand fell 1% from the prior week and was 0.7% below the moving 4-week average. And again, it's just going to be a matter of how much of that is caught up in Henry. Some of that is going to be in this number. Some of it will be in this week's number. And then when we look to Monday, according to GasBuddy data, Monday U.S. gasoline demand jumped 2.9% from the prior Monday, but was 1.2% below the average of the last 4. And then there was the demand jump of 5.1% of Henry versus the prior. So definitely a rise in that demand, but this is typically it's still below what normally happens during large storms. This came in much weaker than expected, which is a positive. But if you watch the news, they were acting like Armageddon was coming. So people did rush and fill up, but even with that, you still see a muted move. And then we're gonna continue to see this, essentially slow down along seasonal lines. And as we were saying, after we hit that peak in July, we expected 1% up, 1% down. July being closer to the high. We got 2 weeks that came close. One of them slightly above, but then again that 1% up or down was kind of our expectation. And here we were able to hit that that nail closely. So then when we look at gasoline prices, they've come down almost 3 cents. They're now $3.15 nationally. Still high, still elevated, still at a pressure point for people. And we're going to talk about wages in the econ show again as the new data has come out. But then on the diesel side, we did see diesel prices come down a little over 3 cents, bringing us to about $3.32. And that's something that we expect to be fairly elevated because we do have trucking demand. We do have that rail demand. So we have a lot of those tailwinds for diesel prices. Where gasoline, you're coming into the end of driving season, but you're also coming to the end of the summer blend. So typically when you see summer into winter blends are cheaper to make. So you naturally have that move down in gasoline prices that happens every year. So this is something that we expect to continue, which will move us closer to the $3, $3.05 mark over the next 3 weeks. So then when we start looking at blending components, this is what we're talking about here, where we're still at those highs. We're not seeing those drawdowns that we have seen on the gasoline side. And I think this is getting us closer to what is truly happening in terms of some of that demand locally, which again is a bit more muted versus what the draws would tell us. And then when we look over the last 15 years, you can see that we had that little bump, and it's again against the 15-year average. But then when we take that, you can see we're still well below the top end of that cloud. And when we pull back a little bit and look against the 5-year average, against the last 5 years, you can see that we're still well off, 17 through 19, and we got that little bit of a bump. But look at the previous years. We'll look at 18. Look at 17, you look at 19. We typically get this increase. Then you get that drop because of Labor Day. Then you get a refill after Labor Day, and then you start seeing those declines along those seasonal norms. It's just when you look at where things were in 2020, we expect to essentially, split the uprights. We're going to be a little bit above 2020, but a little bit below the average. So it's not going to be quite normal, but we expect it to move along seasonal norms just at a more depressed level. But above 2020, you can see how close that gets. And, that line that we're going to essentially walk as we go through, not just the end of summer, but also as we get more importantly into that summer driving into that winter, that shoulder season as kids go back to school. But kids are going to go back to school. Parents are still not really going to the office, or they're not going to the office as frequently. And that's going to be, again, that difference where we expect to see weekday travel about, 15% below normal, but we do expect weekend travel to remain elevated, let's call it plus 5% versus normal, but net still below where we typically are at this time of year. And here's where we see, transit stations continuing to come down a bit. Workplaces have leveled off at that flat line, as we talked about earlier, where when we look at residential, retail, recreation, things still remain elevated. People going to parks, again, still something very seasonally connected to where we were in 2020. So then when we look at things, slowing down, Italy still remains robust, still off those highs that we talked about last week, but you're starting to see some of this weakness coming through. But again, weakness is relative because we're just comparing it to where we were in 2020. UK down a bit, US, Germany down a bit. You can just start to see some of this some of this decline, and we expect it just to continue to move along similar lines that we saw in 2020. So then when we look at propane had a build of about 1.99 million. That's still 14 million below the 5-year average. And when you look at just where we still sit right along the lines of where we were in 2017, which again supports pricing. We still have a lot of exports. We still have a lot of demand. A lot of these things are going to be robust and keep us fairly low, which again is going to support NGL pricing, LPG pricing, and keep things fairly bid. Now, when we look at vaccines, just to look at where the pace is, the U.S. still remains slow. India, same thing. Germany, world has been fairly flat at this level of about 0.43 of 100 people, so 43 out of 100 of vaccinated. Things that are picking up is in Japan, but again, you can see a lot of areas within Asia still not hitting that schedule. Then when we look at just where things sit right now, so the U.S., when you look at 51% fully vaccinated, that still remains the case. We had a little bit of an increase of the first dosage, but still starting to get, that slowdown point as the U.S. falls off of, those peak levels with France moving up, Italy moving up. But again, you look at India still down for the fully vaccinated, but seeing a nice increase in the partially vaccinated. I don't know about you. I know anecdotally we're hearing more and more about breakthrough cases. Now the question is going to be, when do you get the booster? What is the drop off of antibodies? Now they're saying after 8 months you should start looking at getting a booster. These are things that are going to remain fluid as we continue down this path of trying to see or get people vaccinated and get back to some sort of normalcy. Then when we look at jet, one of the things that we were saying was that we were going to see a drop in demand, not taking out. We weren't going to see a new low. It was just going to be right along the lines of previous lows, and we're right on the money. We had a build of 1.45 million barrels in jet storage. So again, not too much exciting one way or the other. We just expect this to continue to go sideways, but move down in a typical seasonal pattern. You can see that we typically get this big drop off, and then we set a new breakdown, and we expect to see something similar above 2020, below the previous, 2016 through 2019. And just split the uprights, because we'll have more activity versus 2020, but less versus previous, because we still don't have the same type of travel on the business side. Obviously, you come down to the end of vacations, less people flying. So again, something very similar to what we've been highlighting. Flight departures, declined 2.2% week on week. Asia Pacific still sees that decline, some rolling over in North America. Again, along seasonal norms, nothing crazy. Europe, we're starting to see a little bit of a slowdown, where the rest of the world had a bit of a pickup. So we still saw a typical, over the next 11 weeks, still that typical decline of about 1.9% since last week, with APAC continuing to be the driver of those cuts. And then when we look at U.S. passengers, as we've been saying since really March, we were going to see a rally along seasonal norms and then a drop off along seasonal norms, but at a rate below 2019. And we saw that again with another drop in activity. So we'll continue to see lower highs, lower lows as we get back to, I think, some of this split between 2020 and 2019. And we'll just see things move along seasonal. Then you see a little bit of increase on the seasonality side. Again, it's just going to be seasonal, just at a reduced rate versus normal. And then when we look at open table, a little bit of a drop, but as we were saying, weekends at about 0 to 5% above normal, with weekdays about 10% below normal. Nothing has changed, even with some delta mixed in, so we don't see too much adjusting over the near term. As it gets a little bit cooler, people might try to go indoors, or they may not feel comfortable going indoors, so that'll see this drop off a bit. But again, nothing too crazy in terms of activity on the restaurant side. And now in the next segment, we're going to look at U.S. exports and what is happening as we progress through spreads, differentials, and what have we seen happen in the international markets.